Olá, o meu nome é José Maria Silva e eu sou coordenador da alocação e inteligência aqui na Avenue. Você está prestes a assistir a uma live que nós fizemos exclusiva para clientes da Avenue, que foi feita em parceria com a Oaktree. Nesta live nós fizemos uma entrevista a Howard Marks, aquele que é uma das grandes lendas do mercado global de investimentos e um dos principais investidores globais em renda fixa. Queremos agradecer aos nossos clientes Avenue pela confiança e queremos agradecer à Oaktree pela parceria e ter permitido esta excelente entrevista. Espero que desfrutem e que aproveitem. It is with great pleasure that we welcome one of the most respected and influential names in the global finance, Howard Marks. Howard is the co-founder and co-chairman of Oaktree Capital Management, one of the largest management firms in the world. Howard has been a reference for both institutional and individual investors for over 4 decades, with a career marked by consistency, analytical rigor, and deep understanding of economic cycles. For those who follow the investment world, Howard is known for his thoughtful approach to risk management, his long-term strategic vision, and particularly for his famous memos. Widely read in the financial community. In these writings, he shares reflections on market behavior, investor psychology, and capital allocation with clarity and depth that really resonate with both beginners and seasoned professional investors. He is also the author of widely acclaimed books such as The Most Important Thing and Mastering Market Cycle, which have helped shape the thinking of investors around the world, always emphasizing fundamental principles like patience, discipline, and risk awareness, something that we really try to bring forward to our clients as well. It is a privilege to have with us someone with this level of experience, clarity of thought, and intellectual generosity, offering so much to learn. Ladies and gentlemen, Howard Marks. Howard, welcome.
Bom dia, Jose. Nice to be with you. Thank you for that kind introduction.
So nice to have you here with me. I've been in the market for quite a while, and I must say that I've read most of your memos. But I will focus during our conversation now, and I will go directly into the nitty-gritty on the latest, because I believe that the last 3 memos, Nobody Knows, Gimme Credit, and Bubble Watch, they kind of touch a lot on very important topics. And I will start on the most recent one because it kind of addresses the elephant in the room, which has been the uncertainty that has been generated by tariffs and different kind of tactics employed by the new administration. I really love the fact that on that memo you call analyzing the future one of the great oxymorons in financial markets. I love that sentence. The approach that you bring forward in Nobody Knows is very marked by that level of humility and clear understanding that no one really knows how things actually work in the world, and you have that experience to bring that forward. You mentioned that you always move with uncertainty and trepidation, which I thought was very compelling. But as we know, investors often feel uncomfortable with uncertainty and tend to seek answers that offer some degree of confidence. So to start our conversation here, what's the main advice you would give to investors during these nobody knows, highly uncertain times?
First of all, when I say there's no such thing as analyzing the future, there's no information about the future. We don't know any of the future. You know, if you want to, if doctors want to study a disease, they get a body, they open it up, they look inside. In our case, there's nothing to look at yet. It doesn't exist yet. You can't get a hold of the information and study it. What we do in our world is we mostly extrapolate the past. Once in a while, we explore whether the past patterns can't be extrapolated, and we try to figure out how and in which ways the future will be different. But you have to understand that that's just conjecture, not analysis. So much of the time, we believe we can extrapolate the past. On rare occasions, we conclude that we can't. I want to state very strongly that at the times when people feel they can extrapolate the past, they usually exaggerate the ability to do so. The relevance of the past to the future is never as high as people think. So when you're totally comfortable that the future will look like the past, you should re-examine your conclusion. Having said that, we're clearly in uncertain times today. Um, in particular, the United States has a president who is not that predictable. If I get to know you, we become friends, and I go out for a meal with you and have a few drinks, and we see each other over a period of time, I'll come to understand how you think, what your beliefs are, and on that basis, I'll feel maybe that I can predict your behavior. In this case, we can't. We don't know exactly how Donald Trump thinks. We don't know too much about his logic. We don't 100% even understand with regard to the tariffs, for example, what his goals are. There are a number of possibilities, but he never exactly says which ones are motivating him. The other thing, and I think this is very important, is that we always felt in the past that presidents meant what they said. They didn't bluff. It wasn't a negotiating position, and thus their words were dependable. Donald Trump values unpredictability. Everybody describes him as transactional. I think that he thinks that when you engage in a transaction, it's desirable to be unpredictable. In our country, I don't know about yours, but if you want to buy a new car, you walk into a dealership and you have to negotiate the price. Everybody knows you don't pay the price on the window. But neither side starts by saying, well, the dealer doesn't say, here, the lowest I'll sell it for is this. I mean, it doesn't say it and mean it. And the buyer never says, this is the most I'll pay and mean it. It's all negotiation. Well, I think we should assume that much of what Trump says is negotiation. And he appears to change his mind often. And that may be negotiation. Or that may be his strategy, to make an extreme request and then either extract concessions or back off and come in again. So it is true that we are living in uncertain times, and it's important to acknowledge that. Now, how does that relate to investing? There are different kinds of strategies. I think the two main investment strategies are owning and lending. Let's say your brother-in-law is starting a business. You have two choices. Your wife says you have to give the money, but you can either buy half of the business and be his partner and rise and fall with his success or failure, or you can lend him some money and hopefully get it back at the end with interest, but you don't have a share in the success, and hopefully you don't have the same probability of failure. So much less uncertain. This is a basic choice that everybody faces, and we can face that choice today. Now, my firm Oaktree, I want to put it on the table. What we do is credit. We do lending for the most part, and I think lending is more dependable than owning. Normally, it has a lower prospective return, but when you give up some return, you get back increased predictability and reliability. I think that credit is a good idea in uncertain times, and the yields today in our market on lending instruments are quite generous. So maybe that would be relevant to your listeners.
100%, and I agree with you. And my background as a sell-side credit research has me with a bias on that favor. So we will get deeper a little bit more into credit without wanting to linger too much here on the political front. I just want you to ask a last one on this topic, because you said that it's very difficult to try to interpolate what's on the mind of the president when he puts in place these tariff policies. I wanted to explore your brain and pick your brain a little bit. It's like, what do you think are the reasons behind the current tariff policies? You mentioned on your memo some reasons, right? You say it's like boost U.S. production, discourage imports, reduce trade deficit, etc. And on that note, what do you think the main consequences could be for the economy given the current scenario?
I think that his prime motivations, and they're interrelated, are to encourage domestic manufacturing, improve the balance of trade. That is to say, we buy more from the rest of the world than they buy from us. He thinks that's a ripoff. Make that better. Raise some money for the Treasury. I think those are his main motivation. The problem is that the reason goods are produced overseas rather than in the US is that it's cheaper overseas. Well, that means that if we bring the production back to the United States, those goods will be more expensive in the future than they have been bought from China or someplace like that. And that means the cost of living will go up. So that's called inflation. And inflation is once you get past a certain level, which everybody says, oh, I'm happy with 2%. But once you get higher, people are uncomfortable. In fact, the bottom half or 2/3 of the income distribution doesn't have any money left as it is at the end of the week. They barely pay for what they need. So by definition, if you raise the prices for those people, living becomes much more difficult. And we're talking about food and medicine and things like that. So higher costs. If the cost of if they have a fixed amount of income and the cost per item goes up, then by definition they can only afford fewer items, which means that the growth of the economy slows down, and so maybe it produces a recession. And most people believe that those are the two likely outcomes. And when Trump announced his extreme tariffs on April the 2nd, before modifying and pausing them, most people concluded that we'd have a rapid increase in prices. And most people moved their expectation of a recession within the next year or so from 30 or 40% to 50 or 60%. So almost doubling the likelihood of a recession soon. And so that's what we're talking about. Now he's backed off a little bit, so now we can't say it quite as strongly. But I think the effects of tariffs in the short run are higher prices for goods in this country and possibility of an economic slowdown. Now, there are the long-term possibilities, which include the rekindling of manufacturing in America. And he says he wants to bring back, we say onshore, the manufacturing of high value added items, not low value added. So he said he gave a speech a week or two ago in which he said, I want iPhones to be made in America. I don't care about T-shirts and baseball caps. I'm fine with those being made abroad. But he's looking at the high tech products. But I guess an iPhone costs about $1,000 now. People have said that if it was produced in the United States, it would cost $3,500. So, what does that accomplish? It produces a few jobs in the United States, but it makes things more expensive, much more expensive for everyone. And we don't have that many people who are interested in working in manufacturing. Only 8% of our population is in manufacturing today. I read recently that there are 500,000 open jobs in manufacturing. So more than 8% of the population could get work in manufacturing if they wanted to. It seems they don't want to. And, manufacturing labor is repetitive and in some cases dangerous. or dirty. And there's no long line of people, Americans, who say, I'd like to work in manufacturing if only I could find a job. Most people prefer to work in services and so forth. So it's not clear how this is going to go, or whether the goals I mentioned can be achieved.
Perfect. Like we said on the beginning, a high level of uncertainty. Uh, I want to move into something that you said on your memo, Bubble Watch, and I will not stay on that for very long because I want to then move to credit and focus on the core of our conversation. But in Bubble Watch memo, you talked about the risk of rational exuberance and the adoration of certain companies like John Maynard Keynes' castles in the air, right? As we know. But you focus a lot on the psychology of the market on that memo as well. You said something on that memo that really resonated with me, which was a bubble is a state of mind. So I wanted to ask you, what's the state of mind of the market?
Um, it's so I think that's always, if you're concerned about the short term, which I try not to be, I might add, that's the most relevant question, is the psychology. I always say that in the real world, things fluctuate between pretty good and not so hot, but in the minds of investors, they go from flawless to hopeless. And so obviously the swings of psychology are much more pronounced uh, in psychology than in reality. And if you think about it, the economy kind of goes like this. It has an upward trend, and some years it's up 2, sometimes 3, sometimes down 1. Modest fluctuations. Corporate profits go like this: up 5, up 10, up 15, or down, because companies are levered. Their business rises and falls, but their profits rise or fall more because they have what's called leverage. But then prices in the market go like this. They fluctuate more than corporate profits, and yet what is a stock? It's a share of a company's profits that you own. So why should the price of the share fluctuate much more than the thing itself? The answer is psychology is very volatile. And so, in the value investing business, or maybe in the investing business overall, we tend to think about things having an intrinsic value. A company has a value, a share has a value, a building has a value. And we try to figure out what that is, and then we look to see whether we can buy a piece of that for less than it's worth. Or do we have to pay what it's worth? Or do we have to pay more than it's worth? And what determines the relationship between price to intrinsic value is how people feel about it, attitudes, popularity. And, if you make a habit of buying things that are popular and they become unpopular, generally you lose money. If you buy things that are unpopular and they become popular, you make money. So that's an oversimplification. And it's very hard to predict popularity or trends in popularity. But I'm just explaining for the audience how things work. And so if you want to buy things for less than they're worth, clearly optimism is the enemy. Because if people are optimistic about something, they'll pay full value or more. And you don't want to get caught up in that. So it's important to assess the level of optimism, which is what you asked me about, and I'm glad to answer. Let's go back to early June of 2022, 3 years ago. What people were saying then is we have inflation, and that's a bad thing. The Fed has raised interest rates to cool off the economy, to fight inflation. That'll probably produce a recession, and that's bad. So everything's bad. The investors were very pessimistic, and that caused the market to fall. And 2022 was the worst year in history for the combination of stocks and bonds. Everybody talks about it's not that relevant. I don't want people to fixate on it, but everybody talks about a hypothetical portfolio, which is 60% stocks and 40% bonds. And 2022 was the worst year in history for that combination. Why? Because people are depressed. But then toward the end of 22, they started to get a little more optimistic. And they said, look, inflation's cooling off. That's good. Economy's still doing okay. That's good. Looks like we're not going to have a recession. We could have a soft landing. That's good. And if the inflation cools off, the Fed can cut rates, which will add to the level of business, and that's good. So now everything's good. We've gone from everything's bad to everything's good. And the swing from pessimism to optimism kicked off a very strong rally in the stock market. And the S&P, which is the main gauge of the U.S. stock market, or the most popular gauge, was up more than 20% in 23 and more than 20% in 24. And according to J.P. Morgan, there have only been 5 times in history when we had 2 years in a row of more than 20. So that's a very strong rally. And by the end of 24, after the 2 up years, the S&P was selling at a high price, a historically high price relative to intrinsic value, relative to earnings, because of the rise in optimism. And we went from a pessimistic market in which if you bought, you probably got great bargains, to an optimistic market in which there are much fewer bargains. And I think that's where we are. I think that the market, it's not crazy. And I said in the memo on Bubble Watch, lofty, but not insane. And I think that's true. But you certainly can't claim that things are cheaper than usual today. By the way, you and I have both made reference to the memos, and I want everybody to listening to know that they can get the memos if they want to read them at oaktreecapital.com under the heading of Insights. You can sign up to subscribe. I hope you will, and it's free. And as one of my colleagues mentioned to an audience the other day, which I hadn't thought of before, if you sign up to get the memos, you won't get any other mail from us. We don't use it as a mailing list for marketing. So I hope you will. And I'm confident that it's good value since it's free.
I'm sure it's good value, and I really recommend for the millennials and Gen Zers as well. There's an Oaktree podcast where you talk about the memos as well for the lazy ones that don't like to read and prefer to listen to it. So there's also that alternative.
Well, first of all, in addition to printing them, there is a podcast where you can listen, and then, as you say, there are memos where we discuss the importance of some of them.
Exactly, and I really love those as well. And on that note, I would like to move to credit. And you wrote a piece called "Give Me Credit," which me as a background as a credit analyst, I really loved it. And you talked about how stocks are valued as intrinsic value, right? And we know that credit is quite different, right? Is relative value in that context. And on that memo, I would just like you to do a quick introduction, because one of the things that I really appreciated the most was how clearly you explained spreads. And sometimes that's something that investors getting into the area don't really get it. Could you take like 30 seconds to explain what credit spreads are and how are they important for credit, and how they relate with yield? And then we will go a little bit more deeper.
Well, I don't know if it's going to take 30 seconds, but the point is, a spread is the difference between 2 yields. So today in the U.S., if you buy a 10-year Treasury note, you get 4.5%. So if your brother-in-law comes to you and says, "I'm starting this business. I'd like to borrow some money. I'll pay you 4.5%." Most people would say, "Well, that's crazy because I can get 4.5% from the government." You're a risky borrower. If you're going to borrow from me, you have to pay me 7%. And he says, "Okay." And then the spread is 2.5%. And the 2.5% is the incremental yield you receive to compensate for the incremental risk. That's what it is. It's a form of risk compensation.
Perfect. You mentioned that historically high yield credit spreads have more than compensated for the average high yield default rate of around 3.5%, since returns net of defaults have typically been well above treasuries, right? So since you just explained how those spreads work, basically you have been historically compensated by the excess returns that you get by taking that risk. You also reflect on the experience of buying high yield bonds when spreads are tight and therefore offer low risk premiums, which is kind of the situation as we are right now, such as right before the 2008 financial crisis, right? You mentioned that on that memo. So I want to ask you, could you expand on that experience and share what investors can expect when buying high yield credit at high valuations, and perhaps also touch on something you often highlight, and you mentioned that on the beginning when you mentioned the brother-in-law contractual nature of bonds, right? How that affects returns expectations, please.
Sure. Well, just to illustrate, before we go into history, let's say you buy you could buy treasuries and make 4.5%, but instead you say, no, I'm going to buy high yield bonds which pay 7%, just like your brother-in-law, and so you get a 2.5% yield spread. Now, in the high yield bond portfolio, let's assume that 2% of the bonds default every year, fail to pay, and become worthless. Well, they don't actually become worthless, but let's say you lose 3/4 of your money. So mathematically, if 2% of your portfolio defaults every year and you lose 3/4 of the money in them, then you lose 1.5% of your portfolio every year to credit losses, but you got 2.5% to take the risk. So you collect the 7% yield, you lose 1.5% to credit losses, you net 5.5%, and that's still better than would have been the case if you had bought treasury. So these are not predictions. This is not even history. I'm just illustrating with some numbers. But so that's the way you should think. Are the credit losses likely to eat up less or more than the spread you're paid to take the risk of credit losses? It's a simple calculation. So if what I showed in the memo was that if you bought at the tightest, the lowest spreads in history, which, as I recall, was about 260 basis points. At basis points, 100th of a percent. So 2.6% was about the tightest spread in history, and it was in the third quarter of 2008. And then Lehman Brothers went bankrupt in September of 2008, and the world had a real panic attack, and bond prices went way down. Even if you had bought at the worst time in history in terms of spreads, if you held a certain number of years, I forget exactly what the number was. You still came out better than if you had treasuries, and there were substantial defaults in 2009. About 9.5% of the bonds defaulted, and you still came out better. So the lesson of history so far is that high yields, even giving up some money to credit losses, is better than low yields.
That's perfect, and that connects a lot with that contractual nature, right? It's like
Right. Well,
you are really able to predict what you are going to get.
Well, let's just go over that once more so that everybody gets it. A bond is a loan, or a note, or all these things: fixed income, credit, debt. They're all contracts. I lend you money. You promise me interest every 6 months, and then you promise me my money back at the end. It's a contract. If you stick to the contract, I know exactly what I'm going to get and when, and you have a lot of incentive to stick to the contract, because if you don't stick to the contract and you go bankrupt, chances are you lose your company. So you're highly motivated. And we've been I was very lucky. I got to start Citibank high yield bond activities in 1978. That's 47 years ago. And over that time period, almost 99% of the high yield bonds we've owned have paid the contract. And so it's been now on average, as you said earlier in this conversation, about 3.5% of all bonds failed to pay. So clearly, to end up with a default incidence like we did, you have to be able to do a superior credit analysis. But I think that this, like they say on TV, don't try this at home. This is not an activity for amateurs. But if you can hire a qualified manager, go into a fund managed by a qualified manager, hopefully they can avoid some of the defaults that occur, and you can have even better outcomes.
That's perfect. I will step out of the memos right now, and I think that on the credit front, we really understand that given the high yield scenario, and I would say that even the quality of high yields compared to 2008 has improved a little better, and given the high yields, we really have a good opportunity right now in the market to step into that universe.
Let's just mention that when I started in 2008, and for most of my experience, the average quality in the high yield universe was what we call B. Credit ratings go AAA. Everybody's heard of AAA. AAA, AA, single A, triple B. Those four categories are called investment grade. Below that is double B, single B, C, D, on down. Those are called non-investment grade or speculative grade. And so when I started, and for most of my experience, the average rating in the high yield bond universe was roughly B. Today, it's roughly double B or double B minus. And so, assuming, and this is an assumption, you have to question all assumptions, assuming that the standards for giving the ratings haven't changed, you can say that the quality of the high yield bond universe is higher today than it has been in the past. I think it's a fair statement.
That's perfect. Stepping outside of the memos, I'd like to change topics and talk a little bit on luck and randomness and uncertainty, as we've mentioned already. And luck, as we all must know, plays an incredible role in investment, more than people sometimes would like to acknowledge. So could you share your thoughts on the role of luck and maybe recount some stories where luck had a real impact in your life, and that randomness really played a role on changing your life?
Sure. Well, look, if you build a bridge and you do your calculations and you put in the right amount of concrete and steel, the bridge will stand for 100 years. And in the world, we don't hear a lot about bridges falling down. If you're a dentist and you go to dental school and you learn how to fill a cavity and you fill it that way every time, you'll be successful every time. In investing, we're very dependent on what goes on in the environment, which I have described as unpredictable. Civil engineering is not unpredictable. Dentistry is not unpredictable. But investing is unpredictable because it deals with the future and it deals with people. Popularity, as I said, and the swings in popularity are dramatic and rapid. So, and then you choose to invest in a company because you think next year it's going to earn $100 million, but there's a frost and the oranges die, and it only makes 50 million. Or there's a hurricane and some buildings fall down, or so there are all kinds of, or the wrong person gets elected, or the wrong team wins a game, and there's no business in Sao Paulo The business is in Santiago instead. So these unpredictable and sometimes random events have a very profound impact on investing, and you just can't make predictions in the investment world with the reliability that you can do in the physical sciences. And this is important. Everybody should realize, the great physicist Richard Feynman once said that physics would be much harder if electrons had feelings. But the investment world is made up of people, and they all have feelings. And sometimes they get excited, and sometimes they get depressed. Sometimes prices go up, sometimes unreasonably. Sometimes they go down, sometimes unreasonably. So this is the life we live in, and luck plays a big part. Everybody has to acknowledge that. And one of the worst things you can do, Jose, is to engage in a high risk activity, thinking that it's a low risk activity. And whether we're talking about mountain climbing or bungee jumping or investing, it's important. It's essential to not underestimate the risk. I can't say that enough. I mean, investing is a good thing in the long run, but very irregular and unpredictable in the short run. Okay, so you asked a question. I know what you're getting at. You want me to tell
the story how you almost ended up at Lehman Brothers. I think
well, now you gave away my punchline.
Sorry, Howard.
but when I was getting out of graduate school in 1969, I knew I wanted a career in finance, but I didn't know what aspect. So I applied for 6 jobs in 6 fields of finance: accounting, corporate treasury office, management consulting, investment banking, investment management. And I didn't care. I didn't know which one I wanted the most. I didn't think about it. I figured I'll let the offers come in and then I'll figure it out. And I got all the jobs but one. And that was the one that I actually leaned toward a little because it seemed more adventurous and more prestigious. So 30 years later, the guy from that company who had graduated from University of Chicago before me, the recruiter, we call him, did something great for the school. So I wrote him a letter and I said, congratulations on what you've done. I don't know if you remember me, but I applied for a job back in 1969 and I didn't get it. But I think what you did here is terrific and thank you. So this was in the days of letters. I don't know if anybody remembers letters. I don't know if you do. But so I sent this guy a letter. And in those days, you had to wait a while till he got it. And then you had to wait a while until he got around to answering. And then you had to wait a while till his letter got to you. So a few weeks later, I get a letter from this guy. And he says, thanks for your note. I remember you. And by the way, he says, if you're ever curious about why you didn't get that job, give me a call. So now I didn't wait for a few weeks. I picked up the phone. I called him. I said, okay, what happened? He says, very simple. We hired the wrong guy. I said, oh, you're sweet to say that. He said, no, I don't mean it like that. I mean, the recruiters all voted to hire you, and the partner in charge was hungover that day. And when he came in, he called your apartment and he gave the job to your roommate. And that's what happened. My roommate went to work at Lehman Brothers. It could have been me. But the people who went to Lehman Brothers in 1969 and who worked there 39 years until it went bankrupt in 2008, if they held on to their partnership stake and it built up and became very valuable, they lost everything in 2008. And so I was, all you can say is lucky not to get that job. And you have to acknowledge the role of luck. And if you're lucky in life, I think you have to be grateful for that. And I think I've been incredibly lucky with the things that have happened to me. And I appreciate that good luck, and I revel in it.
That's amazing. How randomness and how serendipity of life really works. And
right.
we have really no control about that, right? I really love that. That's a great message. I know you have a hard stop in 15 minutes, so I wanted to ask, when you started your career, you started on the equity side, very similar to me. I started on equity research and then moved to credit research. So how did those early years as an equity analyst shaped and influenced your view and the way you have your investment philosophy? And what was the catalyst for moving to the fixed income side?
Yeah, thanks. Well, I think that's another good story and hopefully useful for your listeners. Um, so I reported to work as an equity analyst at Citibank. I believe it was September 22nd of 1969. And the bank and most of the banks in those days primarily invested in the stocks of what were called the Nifty 50. And these were believed to be the 50 best and fastest growing companies in America. Companies that were so good that A, nothing could ever go wrong, and B, there was no price too high. And so they were very glamorous companies selling at very high prices. If you bought those stocks the day I got to work and you held them for 5 years, tenaciously, firmly, faithfully, you lost about 95% of your money. And it was a real disaster. They collapsed because some of the companies ran into trouble, but all of them had been overpriced, and they went from being overpriced to being cheaply priced in 5 years. 73.4 was a very difficult climate in the stock market in general. The S&P was down about half. The Nifty 50 were down more than 90%. So by that time, I had become director of research at Citibank, and I was part of the administration that was responsible for that debacle. A new chief investment officer was hired. He wanted his own director of research. I don't blame him. And so he said, "What do you want to do next?" I said, "I don't know." I listed a few things. He says, "Here's what I want you to do. I want you to move to the bond department," which was the equivalent of Siberia in those days. "And I want you to start a convertible bond fund." And I did, and I loved it because it was a small niche where you could gain an edge, and I felt I did through hard work, hopefully skill, and maybe good luck. And then in August of 78, I got the phone call that changed my life. The head of the bond department called me up and he said, "There's a guy named Milken or something out in California. He deals with something called high yield bonds. Can you figure out what that means?" And I did that. And that was the very beginning of the high yield bond industry. And it's great to be at the beginning. And, it's a wonderful advantage. Malcolm Gladwell wrote about it in his book, Outliers. So, that was arguably that was the worst thing that ever happened in my career, to be dumped as director of research. Fortunately, in those days, American corporations gave lifetime employment, pretty much, and I wasn't fired. And I ended up, through luck, being assigned to probably the best place you could be over the subsequent 47 years.
Thank you for that, and thank you for starting that high yield market, because I wouldn't have a career without you. So thank you for that.
By the way, let me add one thing. What I learned from that experience, that's the important thing, is not what happens to you. It's how you face up to what happens, and it's what you learn. You must learn from your experiences. And in fact, one of my mottos is that experience is what you got when you didn't get what you want. You don't learn much from success. Hopefully you should learn from your failures so you don't repeat them. What I learned is encapsulated in a couple of mottos. It's not what you buy, it's what you pay that determines whether you're successful. And investing isn't a matter of buying good things, but of buying things well. And those two things came out of that experience. And they're the lessons that have guided my life.
Perfect. I hope the audience is pen to paper taking notes on these life lessons. You say sometimes, a quote that I love from you is that being too far ahead of your time is sometimes indistinguishable from being wrong. So I want to ask you, have you ever held a contrarian credit view that really has tested your patience and conviction? And how do you know how to pivot or how to persist with that idea?
Well, let me comment first on the second part of your question. How do you know? There are many, many things about which people say to me, how do you know? How do you know you should buy something? How do you know you should sell something? How do you know you should stick with an idea that's not working, etc.? And there's never an easy answer. I can't tell you how you know, you know. And I can tell you what to think about, but I can't tell you how to think. I can't make you a good thinker. And some superior investors are people who are better thinkers in some ways. That's all. You have insights that the average person doesn't have. That that can be the only answer. But um, sometimes, as you say, it can take a long time. And you buy something and it doesn't go up. In fact, it goes down. You look like you're wrong. You may be wrong, or you may be right, and it's going to take a while for it to work out. But in the meantime, you look wrong, and it's painful. And you have to have the currents of your conviction. But again, no easy answers. If you have an incorrect idea and it goes against you, and you stick with that idea unreasonably, the courage of your convictions is not a good thing, because sometimes you should change your mind. So whenever you have something, whether it works or doesn't, every once in a while you should re-examine your data, re-examine your thesis, re-examine your reasoning, and then decide whether whether you should stay with it now or give up on it and move to something else. And I can't tell you how to make that decision, but it is an essential decision. So you have to have the courage of convictions, but excessive courage of the conviction is called hubris and believing too strongly in your conclusions. Um, but, an example is that in '05, I turned quite negative on the markets for the simple reason that uh, uh, dumb deals got done with ease. The market should be a vigilante. It should look at the things that are getting done, and it should say, no, that's unreasonable. We're not going to do that. We reject that. That's too risky, or the compensation for taking risk is not sufficient. That's the job of the market, which means to say the job of the people in it. And if the market is not being a strict disciplinarian and is letting stupid deals get done, that's worrisome, because it means that the water supply is being poisoned. And in '05 and '06, I wore out the carpet between my office and my partner Bruce Karsh, great money manager who I've been partners with 30 eight years. And I would walk into his office and I'd say, "Look at this piece of junk that got issued yesterday. That shouldn't happen. If a deal like that can get done, there's something wrong. The markets are wrong." So we reduced our risk. We sold a lot of assets. We liquidated some large funds. We raised only small funds or no funds. We raised our standards for investing, and we raised a lot of money at the beginning of '07 or during '07. But I can tell you, '05 and '06, the people who took the big risks made the most money, and that wasn't us. We looked wrong. But you have to, if you re-examine your thesis and you believe it, you have to stick with it. David Swensen, who did a great job managing the endowment at Yale for 35 years until he passed away recently, had a great saying in his book. Uh, he he said, investment management requires the adoption of uncomfortably idiosyncratic positions. And this is a great two words, if you don't do things that are idiosyncratic, that is to say, different from what other people are doing, how are you going to be a superior investor? But if you're doing things that are different from other people, if you're not a little bit uncomfortable, there's something wrong with you. So uncomfortably idiosyncratic is a great phrase that everybody should keep in their minds.
Love it.
By the way, I don't recommend being idiosyncratic just for the sake of being different. You have to do it on the basis of a lot of research and a lot of thought and probably a lot of experience.
Perfect. Great tip. Howard, I wish I had 2 more hours here to pick your brain and collect those golden nuggets that you keep on delivering. But to take us home, and I think you're known in the market as an avid reader as well. So for me and for the audience at home, I would like you to share any book recommendations that you might have, either timeless classics or things that you have been reading lately that really stuck up for you. So any recommendations? I think that after your quotes and after your own recommendations and reading the memos, everyone please subscribe to the Oaktree Memos. But any recommendations of books that you might have?
Am I allowed to recommend my own book?
Yes, you are. Of course, I
Okay.
mentioned them on the introduction on the beginning, but please.
And I'm half kidding, but I hope everybody will read. The first book was called The Most Important Thing, and it talks about, there are 21 chapters, and each one says the most important thing is, and then it's a different thing, because there are so many things in investing that are important, and many of them are counterintuitive. But I was thinking about your question as I prepared for today, and I think a book I would recommend to people is an old one. I read it in 1999. It's called Devil Take the Hindmost by Edward Chancellor, and it's the history of financial speculation. And by reading it, I think you'll get an appreciation for the excessive swings of investor psychology, and what is the positive psychology that produces bubbles, and what is the negative psychology that produces crashes. And if you buy assets in bubbles and sell them in crashes, you're going to go broke. But if you can master the field and your own psychology, and you can buy in crashes and sell in bubbles, you'll have a very successful investment career. Now, the opportunities to do so don't come along very often. Only half a dozen times in my 56-year career. But I think, so you can't make a career out of buying in crashes and selling in bubbles, but I think it can inform what you do every day. Your first question was about what's the personality of the market today? And I think understanding the cycles in psychology will help you understand that.
That's a great tip. Howard, I know you have a hard stop. I want to sincerely thank you for your time. I know your schedule is very busy, so I truly appreciate you taking the time to speak with me today and to help Avenue's client make a little bit more sense of investing and a little bit more sense of the world around us and this psychology of humans that at the end of the day are the ones who are investing. It has been an honor to spend this time with you. I want to thank you. I want to thank the whole Oaktree team for your partnership and cooperation with Avenue. And closing remarks for you, if you have any message to give to our clients, please, the floor is yours. Thank you very much.
Well, I just want to say, Jose, that your questions have been very good, and we had a very enjoyable and I think hopeful discussion. So I thank you for that. It's my pleasure to appear on the Avenue webinar and hopefully contribute to your business objectives. And I just want to say to the listeners, I hope it's been helpful. I hope I've been able to explain some concepts that maybe they didn't understand before. My goal is not to make investing sound easy. In fact, part of what I want to do is clarify how hard it is. It's a great idea. People should engage in it, but they shouldn't overestimate their ability to do it, which means they should get help. Thank you for having me on today.
Thank you very much. Thank you for your time. It was an honor. It has been a pleasure. And I hope it was not the last time. Thank you very much.
Me too.
Aos nossos clientes, aos nossos convidados, até à próxima. Foi um prazer. Espero que tenham gostado.